Most people believe losing money is the greatest financial danger they will ever face. That belief sounds reasonable, yet it quietly destroys more wealth than almost anything else. The real danger is not losing money once. It is spending an entire lifetime protecting every dollar so carefully that it never has the chance to multiply. While most people obsess over avoiding short-term losses, they rarely notice the invisible cost of doing nothing. Money sitting still may feel safe, but time never sits still. Every year you delay investing is a year compounding can never give back. This is where the wealthy think differently. They do not ask, "How can I avoid all risk?" They ask, "Which risks are worth taking?" That single question separates investors from spectators. Intelligent risk is not gambling. Gambling depends on luck. Intelligent risk is built on knowledge, probability, patience, and understanding the downside before pursuing the upside. The objective is never to eliminate uncertainty, because that is impossible. The objective is to make uncertainty work in your favor over long periods of time. Behavioral finance explains why this feels so difficult. Human beings are naturally wired to protect what they already possess. A potential loss creates stronger emotions than an equally sized gain creates excitement. That instinct helped our ancestors survive, but in modern investing, it often produces the opposite result. Fear encourages people to wait for perfect certainty, even though perfect certainty never exists. By the time an opportunity feels completely safe, much of its value has already disappeared. The hidden cost of this mindset is opportunity cost. Every dollar that remains permanently on the sidelines sacrifices future growth that can never be recovered. Two people may earn the same income, yet decades later one becomes financially independent while the other struggles to retire. The difference is often not intelligence or salary. It is that one consistently accepted calculated uncertainty, while the other consistently delayed action. Small decisions repeated over many years eventually create enormous differences because compounding rewards time more than timing. This does not mean every investment deserves your money. The most successful builders are not fearless, they are selective. They study opportunities, understand the downside, diversify intelligently, and only risk capital where the potential reward justifies the uncertainty. Their confidence comes from preparation, not optimism. They know mistakes are inevitable, but refusing to participate is often the most expensive mistake of all. The irony is that people trying hardest to avoid risk often accept the greatest one without realizing it. Inflation quietly reduces purchasing power. Cash loses value. Opportunities disappear. Years pass. Remaining inactive feels comfortable because the losses happen slowly, but slow losses are still losses. Financial safety is not created by avoiding movement. It is created by making disciplined decisions that allow your capital to grow faster than time erodes it. The path to wealth has never belonged to reckless gamblers. It belongs to people willing to accept intelligent discomfort today in exchange for greater freedom tomorrow. Real wealth begins the moment you stop asking how to avoid every risk and start learning which risks are actually worth taking. Because in the end, the greatest financial risk is rarely losing money on a well-considered decision. It is allowing fear to convince you that standing still is the safest strategy, while time quietly turns caution into permanent limitation. If intelligent risk is the price of building wealth, then your greatest obstacle is not the market, it is your own brain. Long before you study investing, your mind has already decided how it wants to react to uncertainty. And unfortunately, it was never designed to make you wealthy. It was designed to keep you alive. For thousands of years, avoiding danger meant survival. Losing food, shelter, or resources could be fatal, so the human brain evolved to treat losses as emergencies. That instinct still exists today, even though financial markets operate by completely different rules. When an investment falls in value, your brain often reacts as if you are facing immediate danger. Fear replaces logic. Short-term pain overwhelms long-term thinking. Instead of following a strategy, people simply try to stop the emotional discomfort. Behavioral economists Daniel Kahneman and Amos Tversky revealed this through prospect theory. Their research showed that people experience the pain of losing money far more intensely than the pleasure of gaining the same amount. A temporary decline feels like failure, even when it is a completely normal part of investing. This explains why so many investors sell during market crashes and return only after prices recover. They are not making financial decisions, they are making emotional ones. The market quietly rewards the exact opposite behavior. Great investors understand that volatility is not evidence that something is broken. It is simply the price paid for long-term returns. Every major market has experienced periods of fear, yet history consistently shows that disciplined investors who stay invested outperform those who constantly react to headlines. The greatest enemy is rarely the market itself. It is the impulse to escape temporary pain. This is why successful investors build systems before emotions appear. They decide how much to invest, where to invest, and how long to stay invested before fear ever enters the picture. When uncertainty arrives, they do not negotiate with their emotions because the decision has already been made. Rules replace reactions. Discipline replaces panic. Their strategy protects them from themselves. Notice how different this mindset is from the average investor. Most people wait until markets become exciting before buying because rising prices feel safe. Then, when prices fall, fear convinces them to sell. They repeatedly buy confidence and sell uncertainty, even though wealth is usually built by doing the opposite. Emotion pushes them toward comfort, while logic quietly points in the other direction. The goal is not to eliminate fear. Fear will always exist because uncertainty will always exist. The goal is to prevent fear from becoming your financial advisor. Every emotional decision made during temporary volatility carries consequences that may last for decades. Every calm decision made, despite uncertainty, strengthens your ability to think independently instead of reacting like the crowd. Real wealth is not created by people who never feel afraid. It is created by people who recognize that their brain is biased toward short-term survival, then build habits strong enough to overcome that bias. Once you understand that your first emotional reaction is often your worst financial advisor, you stop asking how to remove uncertainty. You start asking how to make better decisions while uncertainty is still present. That shift is where disciplined investing truly begins, and it is one of the most valuable advantages anyone can develop. Most people lose money for a surprising reason. It is not because they lack intelligence or because they choose terrible investments. They lose because they become bored. Modern society teaches us that progress should feel exciting, fast, and constantly visible. But wealth follows a completely different rhythm. The greatest fortunes are rarely built through constant action. They are built through long periods of disciplined inaction, while compounding quietly does the work. What feels boring to the average person often becomes extraordinarily profitable to the patient investor. This is why so many people constantly jump from one opportunity to another. One year they chase cryptocurrency, the next they rush into artificial intelligence, then real estate, then options trading, convinced that the next trend will finally change their lives. Each new opportunity creates excitement, but excitement rarely compounds. Every time they abandon a proven strategy to chase something new, they reset the very process that creates lasting wealth. They mistake activity for progress, when in reality, constant movement often destroys momentum. The world's greatest investors followed a very different path. Warren Buffett built much of his fortune by owning exceptional businesses for decades, rather than constantly searching for the next big trade. John Bogle proved that millions of ordinary investors could outperform professionals simply by consistently buying broad market index funds and refusing to react to daily market noise. Their strategies were never exciting. They were effective because they allowed time to become their greatest advantage. The real challenge is psychological, not financial. Human beings naturally crave stimulation. We feel productive when we are making decisions, adjusting strategies, or taking action. Sitting still feels uncomfortable because nothing appears to be happening. Yet compounding is invisible in its early years. Progress seems insignificant until enough time has passed for small gains to multiply into something remarkable. Most people quit during this quiet phase because they confuse slow progress with no progress. Patience, therefore, becomes a competitive advantage. In a world where everyone reacts instantly, the ability to remain disciplined separates builders from spectators. While others are distracted by headlines, market predictions, and daily price movements, patient investors continue following the same strategy. They understand that temporary volatility is simply background noise. Their attention stays focused on decades instead of days because they know wealth is measured over long periods, not short emotional moments. Another reason boredom becomes so valuable is that it protects people from unnecessary mistakes. Every additional trade creates another opportunity for fear, greed, or overconfidence to influence judgment. Constant buying and selling often increases costs, taxes, and emotional stress while producing weaker long-term returns. Doing less is not laziness. When guided by a sound strategy, doing less often reflects greater discipline. Sometimes the highest return decision is simply refusing to interrupt a process that is already working. This requires trusting systems instead of emotions. Successful investors understand that markets will always experience uncertainty, optimism, and panic. None of these conditions change the mathematics of long-term compounding. Their confidence comes from consistency, not prediction. They accept that there will be years when progress feels invisible, because they know invisible progress eventually becomes visible wealth. Most people are searching for a strategy that feels exciting. The truly wealthy search for one they can follow for decades. That is the difference. Wealth rarely belongs to the fastest thinker or the busiest investor. It belongs to the person who can remain patient while everyone else becomes restless. Because in the end, the greatest fortunes are not built by constantly chasing the next opportunity. They are built by having the discipline to stay committed to the right one long after the excitement has disappeared. If fear keeps most people from investing, the desire for certainty often pushes them into the worst investments imaginable. Human beings naturally crave predictability. We want guarantees, stable outcomes, and the comforting belief that success can be achieved without meaningful risk. That desire is understandable, but financial markets do not reward certainty because certainty rarely exists. In fact, the stronger someone promises guaranteed returns, the more carefully you should question what they are selling. History is filled with people who lost fortunes not because they accepted intelligent risk, but because they believed someone had eliminated risk entirely. Fraudulent investment schemes almost always begin with the same promise: steady profits, little volatility, and almost no chance of loss. These offers appeal to a basic psychological weakness. People stop asking whether something is realistic because they become emotionally attached to the idea of safety. The promise of certainty quietly disables critical thinking. One of the most famous examples was Bernie Madoff. For years, investors trusted him because his returns appeared remarkably consistent. While legitimate investments naturally moved with changing markets, his results looked almost perfect. Instead of creating confidence, that consistency should have created suspicion. Real markets fluctuate. Real businesses experience setbacks. Real investing involves uncertainty. The absence of uncertainty is often the biggest warning sign of all. Successful investors understand this principle. They never confuse confidence with certainty. They know that even the greatest businesses experience difficult years, and that every asset carries some level of risk. Rather than searching for investments that cannot fail, they search for investments where the long-term probabilities remain strongly in their favor. Their goal is not to predict every outcome correctly. Their goal is to consistently make decisions where the expected reward outweighs the potential downside. This shift changes the questions they ask. Instead of asking, "Is this investment safe?" they ask, "What risks am I accepting, and am I being compensated for them?" Every intelligent decision begins by acknowledging uncertainty instead of pretending it does not exist. Builders understand that hidden risks are far more dangerous than visible ones. When someone openly discusses possible losses, they are usually being more honest than someone who promises effortless success. The same mistake appears outside investing. People wait for the perfect business idea, the perfect economic conditions, or the perfect moment to begin. They believe certainty will eventually arrive if they gather enough information. It never does. Every meaningful opportunity contains unanswered questions because the future has never been completely predictable. Waiting for absolute certainty usually means arriving after the greatest opportunity has already passed. This is why disciplined investors build strategies instead of predictions. They diversify, maintain realistic expectations, and prepare for temporary setbacks before they happen. Their confidence comes from knowing they can survive uncertainty, not from believing uncertainty will disappear. They accept that occasional losses are part of a successful long-term strategy because avoiding every loss is impossible. What matters is ensuring that one mistake never becomes catastrophic. The market has a way of exposing people who confuse optimism with wisdom. Exciting promises often attract the largest crowds, while simple, transparent strategies receive far less attention because they appear ordinary. Yet history repeatedly shows that sustainable wealth is usually created through patience, discipline, and realistic expectations, not extraordinary promises. The people who remain financially successful are rarely those chasing certainty. They are those who become comfortable making thoughtful decisions in an uncertain world. The greatest financial illusion is believing that safety comes from eliminating risk. True safety comes from understanding risk, preparing for it, and refusing to let attractive promises replace careful judgment. Once you stop searching for certainty and start building resilience, your relationship with money changes completely. You no longer need impossible guarantees to move forward. You simply need a strategy strong enough to succeed despite uncertainty. That is the mindset that separates disciplined investors from those who spend a lifetime chasing promises that were never real. Many people believe earning more money automatically leads to becoming wealthy. It sounds obvious. Increase your income, and your financial future should naturally improve. Yet history tells a different story. Countless professionals earn 6 or even 7 figures while living paycheck to paycheck, while others, with far more modest incomes, quietly build lasting financial independence. The difference is rarely income alone. It is what happens after the money arrives. Wealth is not created by how much you earn. It is created by how much of your income remains available to build your future. This is where lifestyle inflation quietly destroys financial progress. As income grows, spending often grows even faster. A larger home replaces the smaller one. A luxury car replaces a reliable vehicle. Vacations become more expensive. Monthly subscriptions multiply. None of these decisions feel irresponsible on their own, but together they create a dangerous cycle. Every raise improves your standard of living, instead of improving your financial position. From the outside, life appears more successful. Behind the scenes, very little wealth is actually being created. Builders think differently. They see every increase in income as an opportunity to expand ownership before expanding lifestyle. Instead of immediately upgrading consumption, they strengthen the assets capable of generating future income. More capital flows into investments, businesses, or productive opportunities that continue working long after today's paycheck has been spent. Consumption provides temporary satisfaction. Ownership creates permanent leverage. That single distinction changes the trajectory of an entire lifetime. One of the most powerful financial habits is protecting the gap between what you earn and what you spend. That gap is where freedom is created. Every dollar left inside that space becomes future capital, capable of producing even more income. As investments compound, the gap grows larger without requiring proportional increases in effort. Eventually, your assets begin funding your lifestyle instead of your labor. This is the point where money starts working harder than you do. Behavioral psychology explains why this is so difficult. Human beings naturally compare themselves with the people around them. When friends upgrade their homes or colleagues buy luxury cars, the pressure to keep pace feels almost automatic. Social comparison quietly replaces personal strategy. Decisions become driven by appearance instead of long-term value. The wealthy understand this trap. They measure progress by growing net worth, not by displaying higher levels of consumption. Their financial confidence comes from ownership, not visibility. Another overlooked principle is learning to invest in your future self before rewarding your present self. Every unnecessary purchase has a hidden cost beyond its price tag. it also represents decades of potential growth that money could have generated if invested wisely. A single dollar spent today is not just $1 gone. It is the future value that dollar might have created through years of compounding. This invisible calculation changes how disciplined investors evaluate every major expense. Notice that many of the world's wealthiest individuals continue living far below what they could easily afford. This is not because they dislike success. It is because they understand that financial independence comes from maintaining flexibility, not maximizing consumption. They value optionality more than status. Every dollar that remains invested increases future choices, while every unnecessary financial obligation reduces them. Freedom is created by preserving options, not by collecting possessions. The greatest mistake is assuming lifestyle should always rise at the same speed as income. Builders deliberately slow that process. They allow investments to grow first, knowing there will always be time to enjoy greater comfort later. Patience creates abundance, because assets continue compounding, while unnecessary expenses permanently disappear. Delayed gratification is not about deprivation. It is about giving tomorrow's opportunities a chance to become much larger than today's impulses. In the end, lasting wealth is rarely determined by the size of your paycheck. It is determined by the discipline to preserve the distance between earning and spending. Protect that gap, and it becomes the engine that funds investments, compounds capital, and eventually purchases freedom itself. Close that gap through endless lifestyle upgrades, and even a remarkable income can quietly disappear. The people who become truly wealthy understand that income starts the journey, but disciplined ownership is what allows wealth to last for generations. Most people believe the secret to protecting wealth is avoiding mistakes. They spend years searching for the perfect investment, the perfect timing, or the perfect strategy that guarantees success. But the pursuit of perfect safety often becomes the biggest obstacle to financial growth. The world's greatest investors never waited until risk disappeared because they understood it never would. Instead, they learned how to manage risk intelligently, allowing every calculated decision to strengthen their ability to build even greater opportunities. Wealth does not compound because risk is eliminated. It compounds because risk is understood. This is one of the biggest differences between amateurs and experienced builders. Beginners see risk as something to avoid. Builders see it as something to evaluate. Before committing capital, they ask simple but powerful questions. What is the downside? Can I survive the worst-case outcome? Does the potential reward justify the uncertainty? These questions transform investing from emotional guessing into disciplined decision-making. The goal is never to be right every time. The goal is to ensure that one mistake never destroys years of progress. As experience grows, something important begins to change. Knowledge reduces uncertainty. The more you understand an industry, a business, or an investment strategy, the less dependent you become on hope. What once felt dangerous now becomes measurable. This is why experienced entrepreneurs often make decisions that seem bold to outsiders, but appear completely rational to them. Their confidence is built on preparation, not optimism. They are not taking greater risks, they are taking better informed risks. Another principle separates lasting wealth builders from everyone else. They expand their risk capacity before expanding their risk exposure. Risk appetite is simply the willingness to take chances. Risk capacity is the ability to survive when things go wrong. Builders strengthen emergency reserves, diversify income, avoid excessive debt, and protect their downside before pursuing larger opportunities. Because of this, temporary setbacks become manageable instead of catastrophic. They understand that staying in the game is always more important than winning quickly. This is exactly how compounding works outside investing as well. Every intelligent risk increases experience. Every experience improves judgment. Better judgment leads to higher quality decisions. Better decisions create stronger results, providing even greater resources for future opportunities. Over time, each calculated decision makes the next one easier because your knowledge, capital, and confidence continue expanding together. Intelligent risk creates a reinforcing cycle where growth accelerates instead of slowing down. The opposite is also true. People who avoid every uncertain situation rarely improve their decision-making. They remain trapped inside the same level of knowledge because experience never expands. Eventually, even small opportunities begin feeling intimidating because they have never developed the confidence that only action can create. The cost of excessive caution is not only slower financial growth, it is slower personal growth. Without experience, uncertainty always appears larger than it actually is. Notice that successful investors rarely place everything on a single opportunity. They make many thoughtful decisions over long periods of time, knowing that no single investment determines their future. This removes enormous emotional pressure. Instead of trying to find one life-changing opportunity, they consistently make decisions where the probabilities remain favorable. Some investments exceed expectations, others disappoint. But because the overall strategy is sound, progress continues. Long-term wealth is rarely built through one extraordinary decision. It is built through hundreds of disciplined ones. The greatest advantage is not becoming fearless. It is becoming capable. Every calculated risk expands your understanding of money, markets, and yourself. Every lesson improves your ability to recognize future opportunities while avoiding unnecessary mistakes. Over decades, this growing capability compounds far faster than any attempt to protect yourself from every possible loss. In the end, lasting wealth belongs to those who stop chasing perfect safety and start building the judgment required to navigate uncertainty intelligently. Because the more capable you become, the less you need certainty, and the more opportunity the world quietly begins to offer. Most people believe their financial decisions are entirely their own. They assume they invest, spend, and save based on logic. In reality, human behavior is far more influenced by the people and information surrounding us than we are willing to admit. Long before you decide whether to buy an investment, sell during a downturn, or spend beyond your means, your environment has already shaped what feels normal. Wealth is rarely built in isolation because financial behavior spreads from one person to another, just like habits, attitudes, and beliefs. Look closely at major market booms and crashes. The same pattern repeats every generation. When prices rise, confidence becomes contagious. Friends talk about easy profits, social media celebrates overnight success, and financial news creates the impression that everyone is getting rich. People who had no interest in investing suddenly rush into the market because they fear being left behind. They are not responding to facts. They are responding to social proof. The crowd becomes their investment strategy. The opposite happens when markets fall. Optimism disappears almost overnight. Headlines predict disaster. Conversations become dominated by fear, and investors who felt confident only months earlier begin selling simply because everyone else is doing the same. Yet this is often when disciplined investors quietly continue buying. They understand that crowds usually amplify emotions rather than improve judgment. Fear and greed spread rapidly because human beings instinctively seek safety in numbers, even when the crowd is moving in the wrong direction. This is why successful investors deliberately build environments that encourage rational thinking instead of emotional reactions. They spend less time following sensational headlines and more time studying long-term business fundamentals. They seek mentors who value patience over prediction. They surround themselves with people who discuss ownership, discipline, and compounding instead of constantly chasing the next financial trend. Over time, those conversations reshape how they interpret uncertainty. What frightens the average investor simply becomes another normal part of the process. Behavioral scientists describe this as behavioral contagion. Emotions move through groups far more quickly than facts. Confidence spreads, panic spreads, impatience spreads, discipline spreads as well. Spend enough time around people making thoughtful financial decisions, and your own standards begin to rise naturally. Spend years around people who constantly complain about money, avoid investing, or react emotionally to every market movement, and those behaviors slowly become your own. Your financial habits are often reflections of your environment long before they become reflections of your knowledge. Your digital environment deserves just as much attention. Every notification, prediction, and dramatic headline competes for your focus. Modern media profits from urgency because fear captures attention faster than patience ever will. The more frequently you consume emotional content, the harder it becomes to think independently. Builders understand this. They filter information carefully, knowing that protecting their attention is just as important as protecting their capital. Clear thinking becomes much easier when unnecessary noise is removed. This does not mean ignoring the world around you. It means choosing your influences with intention. Before accepting financial advice, ask whether the person giving it has demonstrated long-term success or is simply reacting to short-term events. Before following popular opinion, ask whether popularity has ever been a reliable indicator of investment quality. The greatest opportunities often appear when independent thinking separates you from the crowd. Wealth is rarely created by copying emotional behavior that millions of others are already following. Over time, your environment becomes your invisible investment partner. It influences the books you read, the conversations you have, the opportunities you notice, and the risks you are willing to accept. Change those influences, and your financial decisions begin changing almost automatically. The people who consistently build wealth understand that mastering money is not only about understanding markets. It is also about building an environment where patience feels normal. Disciplined investing becomes a habit, and emotional reactions lose their power. Once your surroundings begin reinforcing rational behavior instead of emotional behavior, better financial decisions stop feeling difficult. They simply become the way you naturally operate. After studying markets, investments, and financial strategies, many people reach the same conclusion. Success depends on finding the right opportunity. But the greatest investors eventually discover something even more important. The real battle is rarely against the market, it is against yourself. Markets rise and fall, economies expand and contract. Opportunities appear and disappear. The one factor present in every financial decision you will ever make is you. If you cannot manage your own emotions, no investment strategy will consistently save you. Lasting wealth begins the moment you develop the discipline to control yourself before attempting to control outcomes. Every financial mistake follows a familiar emotional pattern. Greed encourages people to believe prices will rise forever. Fear convinces them they will never recover. Impatience pushes them to abandon long-term strategies for short-term excitement. Confidence after a few successful investments creates overconfidence, leading people to take risks they never would have accepted before. These emotions are completely normal. The difference is that ordinary investors obey them, while extraordinary investors prepare for them. They understand that emotional discipline is not a personality trait, it is a skill built through repetition. This is why the greatest wealth builders rely on principles instead of impulses. They continue investing during uncertainty because their strategy was designed long before emotions appeared. They refuse to chase every exciting opportunity because they understand that consistency creates greater returns than constant activity. Their confidence comes from following a proven process rather than trying to predict every market movement. Instead of reacting to temporary emotions, they repeatedly return to the same disciplined habits that have worked across decades. One of the most valuable financial abilities is delayed gratification. The willingness to sacrifice a small reward today for a much larger reward tomorrow sits behind nearly every great fortune ever built. Compounding requires time, and time rewards people who remain patient when immediate pleasure competes with future freedom. Every unnecessary purchase, every emotional investment decision, and every impulsive financial move quietly steals from the future version of yourself. Builders think differently because they constantly ask one question: will this decision make my future stronger or weaker? That simple habit transforms everyday choices into long-term advantages. Over time, disciplined behavior becomes identity. Saving is no longer something you force yourself to do. Investing is no longer something you remember occasionally. Learning, evaluating risk, and thinking long-term become automatic because they are no longer isolated actions, they become part of who you are. This is the point where wealth starts compounding far beyond money. Better habits produce better decisions. Better decisions create better opportunities. Better opportunities reinforce stronger habits. The cycle begins accelerating because your character is now supporting your strategy instead of fighting against it. Another truth becomes clear as experience grows. Financial freedom is not simply the ability to spend more. It is the ability to make decisions without being controlled by fear, status, or short-term emotion. The wealthy often appear calm during periods when everyone else is panicking, because they have trained themselves to separate temporary market conditions from permanent financial principles. They understand that uncertainty is inevitable, but emotional reactions remain optional. Look back at every lesson in this journey. Intelligent risk requires self-control. Patience requires self-control. Ignoring the crowd requires self-control. Protecting the gap between income and spending requires self-control. Every principle eventually points back to the same foundation. Money amplifies behavior. If your habits are weak, greater wealth often magnifies poor decisions. If your habits are strong, greater wealth magnifies intelligent ones. The market rarely changes who you are, it usually reveals who you have already become. In the end, lasting wealth is not created by finding a perfect investment or predicting the next economic trend. It is created by becoming the type of person who consistently makes rational decisions when emotions tempt everyone else to do the opposite. Master your impulses before you chase higher returns. Build discipline before you build a portfolio. Strengthen your character before you strengthen your balance sheet. Because markets will always remain uncertain, but a person who has learned to master their own mind possesses an advantage that continues compounding for the rest of their life. That is the ultimate wealth lesson. The greatest investment you will ever make is not in the market. It is in becoming someone capable of succeeding regardless of what the market does next.